The Chancellor proclaimed that Britain is open for business during his speech, following the announcement that the main rate of corporation tax will be reduced to 21% from 1st of April 2014 and 20% from 1st of April 2015. This means that for the first time since 1973, the UK will have only one rate of corporation tax. This is in stark contrast to some of our international competitors. This is, appreciate it might be difficult for you to read some of the names on here, but this is basically the CT rates in the G20 countries. And you've got at the top the USA up at 40%, France here in the 30s, Germany here about 29%, and you'll see that the UK at 20% will be the joint lowest. Now, other regimes are available. Ireland, for example, as most of you will be aware, where the rate I think is 11%, have done very well out of getting international companies to headquarter there. And that, of course, is what this headline rate is all about, and why the Chancellor has made this a key objective since before the general election. He knows that by being, as it were, at the top of that league table of low CT rates in developed economies, he makes the UK an attractive location for international businesses to headquarter. So let's hope for all of us, and the sake of the UK economy, he's right about that. But looking at it from the point of view of our owner-managed business clients, what does it mean for them? For many years, we've advised clients to minimise the number of associated companies they have, because that split the limits for the small company rate and the large company rate. You divide by the number of associated companies. From April 2015, will it still matter, or can you go out and start setting up companies willy-nilly? Well, before you do that, remember, remember, there's not just about the rate. Large companies pay their corporation tax earlier through quarterly payments than small or marginal companies. So, although we haven't seen the detail yet, it may be that minimising the number of companies that you operate through may still be a good idea. And the reduction in corporation tax throws up again the whole question of how should I structure my business. And we've been working with clients for a number of years as the corporate tax rates keep coming down, looking at how their businesses can best be structured. And many of our unincorporated clients have now got some sort of corporate structure to benefit from the lower corporation tax rates. This is something I've talked about in some detail at a couple of our recent presentations, so I'm not going to go into it in a great deal of detail today. However, in the autumn statement last year, partnerships were identified by the government as an area which needed re-examination due to perceived abuses. As a result of this work, the government is now going to consult on measures to address two specific concerns. The first is the situation where a business takes a number of typically high-paid employees, perhaps salespeople in a car dealership or something like that, and actually, rather than having them as employees, makes them members of an LLP which provides their services to the company, thereby saving the company the 13.8% national insurance on their salaries. That works at the moment because the presumption of the tax law is that the members of an LLP are self-employed, so there's no issue around their status. That the government thinks needs to be looked at. But the other one, which is a more wide-ranging concern and probably of more relevance for those in the room this morning, is that the government has signalled that it's concerned about manipulation of profits and losses in partnerships, whatever that means. Now, this, I think, should be a cause for concern, particularly for those sectors where use of partnerships and LLPs is still widespread. And I'm talking principally about professional services, which is obviously us, and also farming, where in my view the partnership structure is far more appropriate for facilitating succession than use of a limited company. And indeed Farmers Weekly, which had a fairly negative take on the budget, I have to say, Farmers Weekly has suggested that the long-standing practice amongst family farming partnerships, whereby elder family members who perhaps now play a fairly small part in the running of the business, are allocated relatively large profit shares in order to shelter that income from higher rate tax, could be a threat. Now this is one to watch, because we're talking not about legislation coming this year, but legislation coming next year. It's certainly going to be one that we keep a close eye on. On a more positive note, annual investment allowance, we saw an announcement in the autumn statement that from the 1st of January this year, the annual allowance for businesses buying plant and machinery will increase to 250,000, or has increased to 250,000 from the 1st of January, which is an interesting U-turn, considering the government only reduced it from 100,000 down to 25,000 last April. The new 250,000 allowance is undoubtedly welcome for capital-intensive sectors such as manufacturing, where the 25,000 annual investment allowance is frankly neither use nor ornament. There are some, should we say, quite interesting transitional rules, particularly for businesses with January or February 2013 year ends, where for that accounting period there will be no less than 3 different levels of annual investment allowance in force during the period. So I'm not going to go through that, but if that's you, do please discuss it with us. And still on the subject of capital allowances, for anyone who's recently purchased a commercial property or is thinking about buying a commercial property, if you haven't already done so, you should be thinking about capital allowances, because it's likely that some of the cost of that property will actually relate to plant and machinery. Typically things like air conditioning systems, lifts, plumbing, heating, sanitary ware and so on. We've been able to offer a facility to assist clients in identifying the plant and machinery and buildings for some years now, and certainly I would encourage you to speak to us if you think you may have unclaimed allowances. But the key point here I wanted to mention is that from April 12 it's been a requirement that the plant and machinery is identified within 2 years of the sale of a commercial property, if the purchaser is going to be able to claim their capital allowances. This is something we did a specialist seminar on recently, but the key point is for professional advisors who are advising on property sales, you need to be aware of the changes in the capital allowances rules to protect yourselves against the risk of a possible claim against you. Research and development tax credits, no significant changes in the budget affecting SMEs, but I wanted to mention it for 2 reasons. One is that this is a specialism that we've developed, and Kershid in particular, our corporate tax manager, is now working with a lot of clients, enabling them to claim additional tax relief on their R&D. So I wanted, whilst we're all gathered here this morning, just to remind you of the basic key points to be looking out for. A company can claim R&D tax relief if it's undertaking a project which seeks an advance in the overall knowledge or capability in a field of science or technology, not simply in its own capability. This advance has to be achieved through the resolution of scientific or technological uncertainty. The project doesn't necessarily need to be successful, it's sufficient to seek success, and the qualifying project must seek to create a new product process or service in a particular field of science or technology. So far we've submitted successful claims on behalf of clients resulting in annual tax savings from about £5,000 up to about £50,000 in a whole range of sectors, from engineering, consumer products, diversified rural businesses, pharmaceuticals, all sorts of things. If you think your business or someone you know who hasn't explored this may be able to benefit, do please talk to us. But that leads me nicely on to something which is new and which is coming into force on the 1st of April, which is the patent box scheme. What this will basically do is it will enable companies to pay a 10% tax rate rather than 20% tax rate on profits which it earns from patented inventions and certain other innovations. And experts within the field of the taxation of intellectual property have said that the patent box scheme that's been introduced by George Osborne in the UK is actually one of the best anywhere in the world. The relief is being phased in from, as I say, 1st of April this year, with the full relief available from April 2017. And you can benefit from it if your company owns or exclusively licenses in patents granted either by the UK Intellectual Property Office, the European Patent Office, or a limited number of other European countries. The company must have undertaken the qualifying development for the patent by making a significant contribution either to the creation or development of the patented invention or a product incorporating the patented invention. So, just to give you a flavour of the sort of thing we're talking about, imagine that you manufacture a printer. This printer contains a patented printer cartridge which is designed to be inserted into this printer, and once it's installed it won't be removed until it's empty and needs to be changed. As the cartridge is incorporated into the printer, income from the sale of that printer, including the cartridge, therefore qualifies for patent box. So if this printer was the only product that you had, all of your profits, once the scheme is fully implemented, would be at 10%. And what I think is interesting is that many of the clients who we're working with on the R&D, we're really getting close to what they're doing in the fields of technology and innovation, and some of those will be patented innovations, which means we're very well placed then to now start talking to them about patent box, because we know the R&D that they've been doing. So again, if you know in your business or any clients who think patent box might be relevant, do please discuss that with us. And now another gratuitous opportunity for some attractive young people on the screen as we talk about employers, and a roundup of a number of budget announcements which will be of relevance for employers. So from April 2014, the government will introduce an allowance of £2,000 per year for all businesses and charities as an offset against their employers' secondary national insurance liability. Although clearly £2,000 is neither here nor there for larger businesses, it will be very welcome for the smaller businesses who perhaps only have one or a handful of employees, where it might significantly reduce their employer's NIC liability. The allowance will be claimed through the normal payroll procedure. Hopefully, everybody by now has heard of RTI, or real-time information. If by any chance you haven't, then from 6th of April 2013, employers will have to send details to the government electronically every time they pay somebody, and within 7 days of making that payment. This information will be used by the government in a variety of ways. Firstly, for actually assessing claimants' entitlement to certain work-related benefits, but also ensuring that companies aren't building up unpaid PAYE and national insurance liabilities, which therefore represent a credit risk from the government's point of view. One change that's happened in the last couple of weeks is that HMRC has announced that small employers, those with under 50 staff, will now be able to report under RTI monthly until October. So I think that's a welcome little bit of relief in what's quite a lot of bureaucracy for the smallest employers. An interesting point that possibly won't affect many of you here, certainly those of you who are in SMEs, but the government has provided further detail about the end of contracting out of the second state pension. Basically, at the moment, if you have a defined benefit or final salary pension scheme, the employer and the employees pay national insurance at a lower rate. As a result of the end of the second state pension, you won't be able to contract out of it, and therefore you won't be able to pay national insurance at a lower rate. So what? I think the interesting point on this one is that some commentators have suggested that what the government is doing here is having ring-fenced the funding for health and education, and probably tied their hands somewhat in doing so. Who is it that employs most people on final salary pension schemes in this country? Well, of course, it's health and education. So whilst on the one hand the government's committed to keep their funding the same, they're going to actually take back some of that funding by increasing the national insurance from 2016, or at least that's the way it looks. A minor change on benefits in kind, where you make a low interest or no interested loans to employees. The limit used to be £5,000 to avoid a benefit in kind and avoid the need to report it on the P11D. That limit's now going up to £10,000. Some employers, use this to fund things like travel tickets and so on, or car park contracts for their employees, and there's a useful opportunity to give a small but nonetheless welcome tax-free benefit to people here. Okay, and finally in this section, employee shareholders, there were a number of changes affecting employee shareholdings in the budget. There's just one that I want to briefly mention, which concerns the Enterprise Management Incentive, or EMI schemes. These are a form of approved share option scheme which typically are used by SMEs. The situation is perhaps that an SME can't necessarily pay a full market rate for the people that it needs, but what it can do is it can offer them the prospect of equity participation in a future sale. There's been two detail changes, or there are two detail changes in the budget that will make it easier for people with options in the EMI scheme to benefit from entrepreneurs relief and pay 10% tax on the eventual sale. Firstly, they won't need to hold 5% of the shares, which is otherwise a requirement for entrepreneurs relief. And secondly, the option period before they exercise the shares will count towards the 12-month qualifying period for entrepreneurs relief, which will make it easier for employees to benefit in a situation where they only exercise the options just before the company is sold. Okay, that's business taxation. A little bit on tax avoidance. Those of you who were here 2 years ago may recall that I spent some time looking at what was then the new government's paper on tackling tax avoidance. We expected a General Anti-Avoidance Rule, or GAR, in last year's Finance Act. In fact, it looks like it's going to come in this year's Finance Act, but only effective from royal assent in the summer. In the meantime, as you'll have noticed, unless you've been on the planet Mars or somewhere, we've had 12 months in which the media has been almost continuously full of stories about tax avoidance, whether by celebrities like we have here, or multinationals like Starbucks. As a consequence, the government's been under some pressure to be seen to do something. Before we look at what they've actually done, I thought it might be interesting to see what the attitude is of the audience we have here today to tax mitigation. In a moment, I'm going to ask you to stand if you are able. This is audience participation time. And what I'm going to do is I'm going to give you 4 different tax mitigation scenarios. Okay? If you consider that that scenario is acceptable tax planning, then I'd ask you to remain standing. If you consider it to be unacceptable tax avoidance, or unacceptable tax mitigation, let me say, then I would ask you to sit down. Okay? That's the game. Okay, so if I could ask you to stand up, please. Okay, right. Okay, here we go. Scenario 1. You run a small business. Your accountant has advised you that if you operate through a limited company, you'll save about £2,000 tax every year. Having confirmed that this advice is both accurate and perfectly legal, would you be willing to do it? If you think that's acceptable tax planning, please remain standing. If not, please sit down. Okay. Second scenario. You pay tax on your salary at the highest rate of 50% currently. Your accountant advises you that he's found a tax loophole. If you buy some special investments, which you sell a couple of weeks later and get all your money back, then the tax rate on the top slice of your income will be reduced from 50% down to 20%. Having established that this planning is perfectly legal and that you'll definitely get your money back that you invest, would you be willing to consider doing it, or would you consider that to be unacceptable tax avoidance? Your opinion. You don't have to look at anyone else on the table. Okay. Third scenario. Okay. Some of you are going to have to sit down at some point. And we've got some very naughty people in the room. Right. Your builder has just quoted you $2,400, including VAT, for some work on your house, but says he can knock off the £400 VAT if you pay him cash. Do you accept the reduced price and pay cash? Okay? If that's unacceptable tax mitigation, please sit down. Yeah. Okay? Okay. And the last one, okay? You've just bought a pub where you were previously working as the manager. The previous owner had reprogrammed the till so that it's only recorded 90% of the takings. Recently had a tax inspection and been given a clean bill of health. Okay, so you're pretty confident that it's not going to be picked up. Would you get the till fixed now that it's your pub? Or would you consider that unacceptable tax mitigation? Okay? Right. Okay. Okay, well, those questions were all taken from a survey that Taxation magazine, the leading authority on tax law since 1927, did of its readership last year. It's a slightly shortened version of their questionnaire, but this is what the respondents of Taxation magazine said. They put in the question about incorporating the business as a control on the basis that everybody, they thought, would consider that to be pretty much conventional, acceptable tax planning. And you'll see that 97% of the readership said that they would do that. What's interesting is that they actually got exactly the same response, which is probably not a million miles different from what we had in the room, maybe, on the income tax strategy one and paying the builder in cash. The income tax strategy one, which is legal but fairly aggressive tax planning, and the paying the builder in cash, which is certainly illegal for the builder, not necessarily for the householder, actually had the same level of support, whilst I was surprised actually even 8% would actually deliberately understate their takings. So we know what you think, we know what the readers of Taxation magazine think. What does the government think? Well, the government said in December that it was absolutely clear that tax avoidance is unacceptable and will be cracked down on. Attempts to abuse the law and bend the rules in a way that was not foreseen or intended by Parliament is unacceptable. Tax planning using the law reasonably in the way that it was intended is okay. Tax avoidance is not the same as tax planning. That's the government's view. Now, the reason I did that was partly for a bit of fun, to stir up the blood a little bit after you've been sitting for 45 minutes, but there's actually a serious point to it, because the way that the GAR is going to work is that there will be a panel who will look at the planning that you have undertaken, and there's what's called a double reasonableness test. Were the arrangements reasonably can they reasonably be regarded as a reasonable course of action? And what we've seen is that from the survey of Taxation magazine amongst leading tax professionals, they're kind of evenly split on whether an aggressive income tax strategy is actually acceptable or not acceptable. So a panel comprised of these people, which way is it going to decide whether your actions have been reasonable or not? Hard to say. Certainly, the view of providers of tax strategies is basically that they're not losing too much sleep over the GAR. They consider that actually it's something that the revenue will find very difficult to make work. I think we can draw some comfort from the fact that conventional low-risk tax mitigation, which sometimes the revenue indicate they don't really like, but nonetheless incorporating your business, some shares to your spouse and that sort of thing, there doesn't seem to be any real risk that the GAR will present a threat to that, which some commentators had earlier suggested. But neither does it look like it's the end to tax avoidance as we know it. And with that thought, I'll pass you over to David, who will now look at some other aspects of the budget.